Today's video, I'm going to be going over how you can take advantage of even the current bad market conditions and still make money every single day trading in the market. And I'm saying this because I know so many traders online. After I finish my trading sessions, I just look around. Sometimes I check online and I notice that a lot of traders, especially other trading communities as well, they seem to be lost in the market conditions because they're saying the market conditions are very bad. There's a lot more chop, a lot more consolidation. Like yesterday or a day before, NQ was literally making a barcode in the opening session, which is crazy. So many of these things, people are getting chopped up. People are literally blowing their accounts, which is crazy to me in the first place. There should be risk management for that. But there's just a lot of people that are really confused right now in terms of understanding where the market's going, where should they be trading, where should their entries be, getting stopped out before their actual move in their direction. And today I'm here to give some solid advice on how you can navigate these current market conditions and what you can do and things like that. So let's just get straight into it. First off, before I get into that or the trade recap, basically recapping today, we made about 7 risk reward with the team. Okay. 4 risk reward, 2 risk reward, and I took 2 losses back to back. Unfortunately, I typically don't take losses back to back like this, but it happens and it is what it is. It just wasn't very clean price action, but this isn't something that's considered bad price action to me, right? This is just manipulation like usual that occurs just a bit more than usual. But the delivery today was definitely much nicer than the past other days. The past other days, it would just take forever to hit my TP, right? Usually, based on my data, it takes about 30 minutes or less on average to hit my TP during New York session. Now, of course, during Asia session, during London session, it's going to take a little bit longer because there's less volatility, less volume, and therefore these candles will take a bit longer to form to hit my TP. But from my data, this is why data is important to understand. I know within 30 minutes or less, my TPs typically hit if I am right on the trade idea. Now, if it takes more than 30 minutes, it's not that it's questionable. It's just sometimes that may occur maybe later in the session. But during the kill zones, usually it shouldn't take too much longer than 30 minutes. But obviously, in the recent trades I've been taking, they obviously are taking a lot longer than 30 minutes. Like today, this one was one of the quicker ones, 16 minutes. So it was a great trade. This one was about my average trade duration, right? But this one took a while. This one was about an hour of trading while holding this trade to really get to my TP finally after all that manipulation, which is something you also need to understand in the market. A lot of people, they don't understand what manipulation is and how to take advantage of it, and therefore they're getting stopped out before the true move towards their drawn liquidity. And again, I sent out all these drawn liquidities to the group as well. I told the group that this was the weak high I was looking to get ran through, looking for longs here to take this weak high out, and that's exactly what happened. And it also aligned with New York session high, so a lot of confluences. But going over the main topic of today's video, which is how to navigate these bad market conditions, I personally think that there's 2 reasons mainly. Number one is the trader that's blowing their account or just losing a lot during these market conditions. They might not have enough experience trading different market conditions, right? Trading 1 to 3 months is not anywhere close enough time to really gain enough experience. I'd say you should be trading for at least 2 to 3 years to say you have somewhat a level of experience of different market conditions, because within a year it could be all bullish, for example, right? We could have something maybe also like COVID where it was very bearish, right? And everyone's making money, right? So understanding market conditions is very important, and therefore that's why I really truly believe that you need to have some experience. You can't just do you can't just go off like 1 month of data, 2 months of data. You need to have a timeline of data plus a sample size of data, right? So 100 trades across 1 month is not valid data to me. It needs to be 100 trades across at least 6 to 12 months or a year or more, right? Now, typically, I don't say to go over the 4-year time span because typically the market thinks certain things about the market may change, and we want to be up to date still with the market without going too far back. So within 4 years is definitely enough data to have to basically validify your strategy or system. So number one, again, the trader doesn't have enough experience, so they're blowing accounts or taking a lot of losses, trading this market conditions where it's very slow. They might be very used to the typical market conditions where typically, again, like I said, price usually hits my TP within 30 minutes or less, right? So it's used to the high volatility. Last month, we had extremely high volatility. And of course, that's driven by fundamental news as well. But my point is we still had extremely high volatility. But despite a lot of fundamentals coming out this month too, we have a lot lower volatility, right? So this is not something we can really change as traders. This is something you just have to pay attention to and recognize. And when you recognize it, you need to adapt. So this trader, number one, that's blowing their accounts or failing is because they can't adapt to the market conditions due to lack of experience. The second reason is that your trading strategy basically might not just be profitable over the long run. I'd say there's a lot of strategies out there. There's a ton of different strategies. And there's a lot of profitable strategies and a lot of unprofitable strategies that don't actually have an edge. Certain things like EMA crossovers have no edge whatsoever in the market. If you're purely trading EMA crossover, you have no edge. I have literally TradingView data. I can literally program something real quick right now within 5 minutes, and you can use TradingView data and literally shows from a backtest across. I think you can go back 4 years or more of data. I don't remember exactly. It's been a while. I think I actually went back 2006. I'll have to check later, but the backtester on TradingView is extremely good. Allows you to go back and robotically basically test out your strategies, things like EMA crossovers, and they don't have an edge. What I mean by they don't have an edge is the profit factor is basically a 1.006. After commission and spread, that is a negative expectancy, okay, in your P&L. So definitely not something you want to be trading. In fact, you should be avoiding strategies like that because it's just a waste of time. It's a waste of your mental capital and your actual capital. So again, number two reason, the trader does not have a robust strategy that works for all market conditions. Some strategies will work better in certain market conditions, like maybe trending environments versus ranging. Other strategies will work better in ranging conditions versus trending. It varies a lot, right, from different strategies. That's why I say not one size fits all, but you need something robust enough where your strategy will still perform under trending or ranging conditions, either of them. Your strategy should be robust enough and optimized enough and refined where you should be able to still be profitable in both market conditions. Because if you can't do that, you're going to have to, number one, either completely avoid trading when you recognize market conditions being consolidating or trending, if that's against your strategy, which can be a hit, of course, on your trading. The reason why is because you need to have that income coming in every month, right, from trading, especially if you're trading full time. Like me, you need to have income coming consistently every single month. And that's also why I like day trading instead of swing trading and other things. You can still make money swing trading. Don't get me wrong. I'm just saying I like the higher frequency for day trading, right? And I don't like holding positions for that long either. That's just not my cup of tea. But essentially the point is, right, you need something that's robust enough from backtested data. So that's why I say backtest enough sample size across a good timeline so you understand these things ahead of time and you don't have to deal with losses later on and get really confused and go on tilt, full on tilt, and blow your account because you don't understand your strategy enough, right? So that is number two. Essentially, again, understanding you need a robust strategy that works in all the market conditions. I'm not saying it has to work very well in every market condition. It can work, for example, if you have a strategy that's a trending market and you know it works very well in trending markets, right? From your backtested data or maybe your live trading data. Well, guess what? It should be very profitable during the trending market conditions. And then let's say you go into consolidation markets or markets where volatility is lower, where you get a lot of ranges, a lot of liquidity sweeps, ton of manipulation. As long as the strategy is still above break even, meaning somewhat green, that's completely okay and acceptable. The only problem is when it goes down below break even, which is red. So you definitely don't want to be red. You preferably not break even. You preferably want to be at least a little bit of green, right? That's all you really need. So just a little rant about two reasons why people are unable to make money right now in the current market conditions, even though they were able to, maybe for example, last month when we had high volatility. These are the two main reasons: experience and a robust trading strategy. Those are the two things that are lacking from a lot of traders online that I've been seeing. Now, don't get me wrong. I'm not saying the market conditions are perfect right now. Of course, they're still bad right now, but I'm still able to make money almost every single day, essentially trading these market conditions. So that clearly shows obviously other traders are doing something wrong, okay, or their strategy is not good enough and robust enough like mine. It's not out of ego or anything. It's just stating the pure facts. I think last week I had about one red day. Other than last week with one red day, and I posted that as well, every other day has been green so far. So I generally don't know. I mean, it might just be, again, lack of experience. Maybe the people posting online are just traders that haven't traded much, might be new traders. That could be very possible. But it's just certain things I've been seeing on Twitter, on Reddit, things like that in my free time. But nonetheless, let's just get back into the video. I'm gonna basically go over the trade recap real quick here. Again, these are trades, and some of our group members actually banked, which is awesome. You know, I love to see our group members in ETU banking as well with me. I know some people, or one trader in our group took the short here, and he TP'd at the flip, which is where I TP'd as well. And then someone also took, one of our other traders also took this long here, and I believe he exited a little bit prematurely, but nonetheless, it's still a good trade, right? It's still a good trade. It's aligned with the bias. He's not counter trend trading, so I'm completely fine with that. And last but not least, he actually took a really good OB continuation model here, essentially to the downside here when there's SMT. Now he trades NQ, but nonetheless, this is ES. I personally like ES. ES is less volatile than NQ on average, but I just started off trading ES, so I've always been used to reading how price moves on ES, and you know, I just stuck with it. Don't fix something if it ain't broke, right? Never try to fix something if it's not broke. So here's the trade recap. I'm gonna make it real short today. I don't want to make it too long. We have a flip here. Okay, so the origin's above here, which is very small. I wouldn't even trade that probably if I saw this. It's very tiny. But we have a flip right here. And some people may even consider this the origin because you might market structure like this, right? So to me personally, this didn't fully mitigate here, I think. If it did here, then sure, that's valid as a new structure, but it seems like it just barely mitigated. So I personally could consider this a flip, but that's not really the main point, right? This is a pre-market trade before New York Stock Exchange opens, right? New York Stock Exchange opens at 9:30 a.m. EST, but the kill zone for New York session opens at 8:30 a.m. So right here, right here. So here is a very straightforward trade here. I took an OB entry model right here. It was on this candle here. I took an OB entry model. My stop loss, I put it above. I got to give some wiggle room. And I talk about this a ton in the course because this happens very often where price will make equal highs or equal lows in futures and wick you out. You don't want to get manipulated out of the market. That's how liquidity forms. That's why people get stopped out early. So you want to be, you know, giving your stop loss some wiggle room no matter what. So that's what I did here. And we TP'd essentially at the flip here. You could TP at here or this bottom one right here. I personally prefer typically the upper one for the most part, unless it's a huge difference in terms of distance far away, typically. But typically I prefer this one. It's a little bit safer because you don't know exactly if price will go back all the way to the extreme one. In fact, you actually went all the way down to the last flip right here. So you don't know exactly which one of these three price will mitigate. This one, or this one. Therefore, I just took the more conservative target here for full risk reward. And at this point, this was a counter trend trade to me. Why? Well, it's very straightforward. So if we go on, let's see. So if we go on, it's the 1 hour. Right here, we have a 1 hour swing low right here. This is very high time frame liquidity. You guys know high time frame liquidity causes big moves in the market. In fact, if you go in the 4 hour, this is also a 4 hour low. After we mitigated this PY here on the 4 hour, we failed to hold and we just did a sweep here. So we have a double sweep of essentially this internal swing low on the 4 hour and this also 4 hour low on the left here. So we have a lot of confluences to go to the upside as my draw on liquidity temporarily. Therefore, this was a counter trend trade to me. And if you were to target a low, I'd say that is a very, at least that's an aggressive target and pretty unrealistic for this trade. So for this word here, I did not close out here. I think this was news. What's this? Market open was, because market open is 9:30 a.m. right here. This candle is bigger than market open. I know we had news today on Forex Factory. I think it was 950 or something like that. So this one? It wasn't a big candle wick, so it's not like you can use this really as a data wick play or trade. But yeah, we did have news come out, and I think it was two news. I think it was orange or red. I can't remember, but we did have news come out. Nonetheless, this hit TP forward towards a perfect trade there for me. Next trade, we took London session high. This was like, I can't make this up, man. This is why I have an indicator to mark this, so I don't have to every single day wake up and have to mark all these things. Because as much as I say don't be lazy, at some point you understand what a session high and low is, right? Like if technology disappeared all of a sudden and I asked you to mark the session high or low, you can still do that, right? So it's not like you can't or you don't know how to do that. You still do. It's just using indicators saves you a lot more time. And matter of fact, let me show you guys something. So here on the right here, I have my alerts log here, and literally these are just alerts that I have set using my indicator. Like literally it's an indicator alert. I programmed it myself, and it just basically gives you alerts when your session high or low, 80 session high or low, or 11 session high or low gets swept, and it triggers once per day or per session basically. And I just have all these set as well as previous day high and low as well, because those are high time frame liquidity points that I definitely don't want to be missing out, right? Those are very important. I'm not going to set another at every single 30-minute or 1 hour high or swing high or low, but these are the main ones you really want to be looking for to take a trade reversal off of. So that's why I have those alerts, and that's why I literally made these indicators, because originally I made these indicators just for myself to help benefit my own trading, to make it, less painful and easier, really, to save me some time, because I hated having to look for the session highs low myself. And I was able to make it visually appealing too, and it looks pretty good. So, and it's the main thing is it's functional, right? I got an alert here. We hit London session high, and what do we have here? Well, this is something I talked within the course very deeply on, but this is a very high quality IFG right here. There's a lot of reasons. Again, I mentioned all the reasons in the course. If you watch the video about IFG setups, this is a very high quality IFG. If you can't see the text here, it does say IFG. It's just the way the candle is right here. But it says IFG right there, and of course it gets inverse right here. And we have 2 risk reward trade here. We just took here, and a stop loss here. You can't really place this anywhere, right? If you place it above the IFG, you would have got stopped out. Here, me personally, you just can't really place it here because there's nothing really structure wise here in the middle of nowhere, right? We want to try to find like a structural spot if you can, and the only structural spot really was that high, so it covered that high, and we TP'd at basically, this would be considered the origin. Yeah, this is the origin here. There's nothing else here. TP'd at the origin. Again, what would this be considered? A counter trend setup, right? 2 counter trend setups. They still worked out as long as you don't have aggressive targets. If you have your target here, of course your winner is going to be very low, right? You just don't have realistic TPs. You need to have realistic TPs in your trading, or your win rate decreases. Here is a very valid setup. We had inducement right here. Okay, I'll just mark this for you guys. This is a break structure. This is also a break structure. This might draw high time for drawing liquidity to go higher, but this was a very high quality continuation setup. It just failed. There's nothing wrong with that. The only thing missing here is a internal liquidity sweep or some sort of liquidity sweep. We didn't get that, but we did sweep inducement. Tapped into origin. This is a continuation model here. There's nothing wrong with this loss here. This is a completely valid loss. I just took it to the chin. I do have a lot of member notes that I did annotate as well. I removed them from this chart because they're for the members that paid for the course and the mentorship students. So hid them for the video. But here you can see there's some reasons why this wasn't a high quality setup, and I basically wrote that down to everyone to let them know. But still took it anyway. I was willing to risk it, and it hit a stop loss. We still maintained structure here. This is the low that made the high. So we maintained the low. This is important. We maintained the low here. I was hoping for this to get swept, but it doesn't have to necessarily get swept, especially in market conditions like this where we chop around a lot, right? Very choppy. It doesn't have to get swept. We can just create new manipulation here. And there's also another reason why I mentioned to the course members why we never came back all the way down here, right? There's a very clear, obvious reason mechanically. This, I took an OB entry model off here. You could have taken this one too as well. I just took another loss here, basically back to back. I was anticipating this was just an internal liquidity sweep. We did kind of either these were equal lows, or we swept this. I don't trade equal lows or equal highs, so whatever this is, point is we still took a loss here going long. It's all good, Still following my setup, still following my plan. At this point, I was up just 4R on the day, and it is what it is. We basically almost broke even here with these trades versus winner. But again, you just don't want to go on tilt. That's the main thing. If you start tilting, and I'm going to explain this real quick because I used to do this when I started trading my first year. It was very bad. It was horrible. My tilting was very bad. I would take a loss here, for example, this long. And a lot of you guys can probably relate, especially if you're still tilting right now. You probably short immediately, go short. You probably target your initial target here, and then boom, price hits you out. Then you go long here, and guess what happens? Price hits you out again, right? It's just doing a mitigation cycle here fractally, which is something I also teach. And If you don't know what that is, you're just going to get stopped out and stopped out, right? And then guess what happens? You hit stop loss going long, and then you try going short here, maybe at this break here, you have a tight stop loss again, and you maybe target a low here, and it wicks you out, basically. It basically wicks your TP, right? For example, and you just miss a trade. And then at this point, you're already like 3 to 4 losses deep, and you just start full porting. That's just how it is, man, when it comes to tilting. And I know about this because I mean, almost every trader that is profitable now has gone through this. I don't think I've known many traders that have never gone through this, because this is just like it's like a canon event that's bound. It's just bound to happen, right? No one's perfect, and neither is the market, right? The market is not entirely perfect because SMT correlations occur, so it might not always take out swing points like this low here, but majority of times it will. I took a break even here. We had a very high momentum here. We did one more sweep here. This was my last attempt, guys, here. Like here, if this trade didn't work out, I'd probably be done. If I go to NQ here, this was, let me see, this was 1056. So what happened here, and the reason why ES did not take out the low was because we tapped into basically the last unmitigated PY here on NQ. Okay, so if you have NQ and ES up, side to side or whatever you want, you will notice this. And this is basically what I call like a mitigation SMT. So instead of us taking out a swing high or swing low SMT, it's like more like an internal SMT when one asset mitigates in PY while the other one does not mitigate the PY yet, or doesn't have any other PY to mitigate, right? Hence why ES actually at the exact same time, as soon as NQ mitigated the unmitigated PY, ES shot up along with NQ. So at that point, you can anticipate we have a chance to go higher. So I just took this IFG. We had very good momentum, all in balance candles. And this is basically a miniature impulse delivery model. So if you took an impulse model here, this is not an A+ impulse model, because you can see how we have a lot of internal structure here. Even though this is trendline liquidity, it's still not a perfect impulsive delivery. So it's not an A+ impulse model. But if you took an impulse model, it would just be a little bit more risky. And you probably wouldn't want to manage your trade very aggressively in terms of break even. I took this one, managed this one pretty aggressively, even though to me this is an A+ setup. The reason why is because of stop loss, man. Like if I put my stop loss here, for sure I would not go break even. But looking at where my stop loss is, we still have tons of imbalance below. Yes, I expect price should deliver with a lot of displacement, but it's not guaranteed, right? It's just probabilities. I know if price does come back to mitigate, we need more confirmation before entering the trade again. We're not just going to blindly enter here. So basically, my stop loss break even. I got hit out at break even, unfortunately. And, you know, it is what it is. And this is, I believe I broke even right here at this internal base structure here, right? So as soon as we made this move here, we came back to mitigate. My entry went higher. At this point, price did not anticipate price to come back down here. We made a stop hunter setup here. If you took that going long, that's valid as well. Waiting for more confirmation when we came back to basically mitigate this buy to sell or sell to buy here. And we got another IFG entry model. You could take this higher one if you want to as well, right here. I just took this one because, you know, we have enough confirmation earlier that we have at least some sort of impulse or momentum in this direction. So there's at least some sort of confirmation with the internal change of character here. I took an IFG entry model here. Stop loss placed below the low. This is a bit more risky still. Why? Because price can still come back down here, mitigate this final OB, and then continue higher. Now, I just don't see that happening because of how much displacement, how big this gap is. The bigger the gap, the less likely price will come back to mitigate an OB there. So that's something I know from experience trading. I took an IFG setup here, told the group I was targeting basically the weak high here as my draw on liquidity, and it ultimately hit for a 3x reward. So basically what happened here is these two losses got canceled out by this winner. And then we have a 4x reward winner with a 3x reward winner, and that is 7 risk to reward in your session. And let's see, how long was this trading session? This was about 3 hours, which is basically the kill zone duration. So 3 hours of trading within the kill zone, 7 risk reward. I'm happy. I'm closing the charts, right? Typically for me, my typical goal, I don't think any of you guys should set a monetary goal for sure. Definitely no P&L goal. I'd say a good goal is maybe something like in terms of risk reward. But even then, I think you can't do that because the market is not binary, ones and zeros. In good market conditions, you will make like 20 risk reward potentially in a session or in a sitting. In bad market conditions, you might only make 3, and you're still taking your A plus setups. It's just how price delivers that affects everything, right? So that's just something to keep in mind. I wouldn't not have risk reward target goals, but to me, just with my experience and such, I'm able to typically make about 10 risk reward per session. Obviously, sometimes it could be much higher. I think last session I had 18 or 19 risk reward, but sometimes it's also gonna be lower, like maybe 7 risk reward, 6 risk reward, right? And I'm perfectly okay with that. As long as I'm trading my system, my strategy, and managing my risk properly and not tilting, I'm completely okay with walking with 5 or 4 risk reward. You don't need to be extremely greedy and making 10 risk reward every single day because that's 200 risk reward a month. I named the advanced course 100 risk reward course because with my strategy system, once you master it, you first off, you'll be able to easily read the market, and second off, you will be able to make 100 risk reward from my backtesting per month, which is a lot. That's a lot. That's 5 risk reward a day if you break it down consistently. So just something you want to keep in mind. Don't get too greedy, guys, especially with the TPs, right? Now, of course, we had so many nice setups later, man. We had a nice sweep of near session kills on a high. Look how perfect, again, session highs and lows work. Boom, perfectly out of reaction. Look at here, London session low, my kills on indicator. Boom, he had a nice reaction here. 80 session high, boom, great trade here. 80 session low, this one failed, right? This was one failure out of like 4 or 5 winners, right? So you see how perfect these timings are and liquidity is. Here, if I were to explain this here, what happened later to the market, we just had SMT here. NQ took out the low here because this is all fractal trend line liquidity. Everything is fully mitigated. Not everything was fully mitigated on ES. This is a 5-minute POI. Hence why it's so important to have your POIs on your chart drawn. If you don't have an indicator like mine here, right, it shows 5-minute right there, you need to be at least switching time frames yourself to find these things. Otherwise, it's going to be a rough road for you because you're going to miss your TPs if you're only aiming for 1-minute OBs or POIs all the time. Sometimes we'll have a POC even and press the reverse off that. So just something to keep in mind. Pretty self-explanatory here though. 5-minute mitigation plus SMT, continuation A plus setup. I don't see really an entry here. Well, there's an entry here off my IFG indicator here. I marked it, but no like very high risk reward entry here, I'd say. Unless you took a SH setup later, which for sure you could definitely get entry here. And you can see we ran so much higher here. But you can see how like important it is to have still like not too aggressive targets, right? Like for example, you don't want to be targeting all the way up here to the left here. There's no reason to, because look, you might even hit break even here, right? When you could just taking 3 risk reward out of the market. That's 3 risk reward. How I see risk reward is I'm up 3 risk reward. That means I can afford 3 losses and still be break even for a day with no risk at all. That's how you should be seeing your risk reward. You need to look at the downside first before the upside. That's how you should be trading, right? That's why risk management is important. You can't just look at the upside with no downside and full pour. Doesn't make any sense. It's not sustainable long term. So that's basically it for this video. It's a pretty long video, but just quick little trade recap. Again, if you want to see these exact trades annotated and such, join the private group, either the private mentorship or just the E200 risk reward advanced course. You get access to the private trading chat with me and all my members. We try to basically give trade ideas and such every single day. I'm in there active pretty much every single day. So again, if you guys want a genuine, check it out. And I'll see y'all in the next one.